Hello and welcome to Camel Finance. I'm your boy Camel, and today I want to talk to you about thinking differently as a trader. Before we get into this, if you're not already subscribed, please subscribe to the channel. We're doing alright, 7 subscribers in the first day. I'm happy with that. And go ahead and follow us on Twitter. We post daily to both of these places. So, thinking differently as a trader. I want to start by playing you a clip that you've probably already seen over the last couple of days. I'm certainly not first to this by any means. And then I want to go off on a tangent and hopefully loop back around to this clip and tie it all together. So the clip I'm talking about, like I said, you've probably already seen it. I'm not going to play too much of it. I'm just going to play a bit of it for you, so you know what I'm talking about.
Oh, wow!
Okay, so why show you this clip? Well, I'm showing you this clip because I want to show you how important it is to be able to think differently as a trader, okay? So to be successful as a trader, you have to learn to think differently, and you must learn to think outside the box. Everyone in finance is out to make money for themselves and themselves primarily. So the news, for example, is not to be used to profit in, is not, in my view, there to help you succeed and to make you money. It's actually there to do the opposite. And the news only serves a purpose, in my opinion, to take your money, to take your hard-earned money and put it into the pockets of Wall Street and institutional traders. So, I have a second clip to play you, which sort of illustrates this point.
Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is really, look, if there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.
Okay, just so you get a sense of what's causing the agony by this point, I know you've been talking about it. It's financials led by Bear Stearns after what essentially is a bailout from the Fed. Bear Stearns shares are down 90% this morning, and it's not just Bear.
So, as you can see, the news not necessarily always on your side. Another example of the conflicts of interest that exist within the industry are brokers and trading terminal providers. These in some places hold massive conflicts of interest, and they can even be somewhat incentivized for you to lose. So for those of you that don't know, when trading with CFDs, this is contract for differences, spread betting or foreign exchange, the contract is between you and the broker. You don't actually own anything. You don't own the underlying asset. You're essentially having a bet with your broker and saying, for example, I bet the S&P 500 is going to go up. And if you're right, the broker will settle that bet with you. And if you're wrong, you will pay the broker. So technically, the broker is always trading against you. Their job is to hedge the risk. And they can do this in a number of ways. They can do this client to client. So this would involve essentially for every retail trader that is long the S&P 500, there will be one of the similar size that is short. So they can match these two together and therefore offset any losses. Another way they can hedge risk is to take the opposite trade. So they can actually hedge the risk by trading in the opposite direction. And they can also take the same trade. And I will give some examples of this in a moment. I think first it's important to say, I do not believe that these brokers manipulate price. I'm not implying or insinuating in any way, shape or form that these providers and brokers manipulate the price or stop hunt or any of this. That's not what I'm saying at all. But what I am saying is there are some conflicts of interest which I hope to outline to you here. The winning clients are treated differently to the losing clients. So what I mean by this is the winning clients, this is the clients that use these platforms and consistently trade with large profits and small losses, then these clients are traded with in the same direction. So that means if one of these clients that is known to be a good trader, especially a good trader in size, the the spread betting or CFD provider, the broker, will match their position so that they don't have to pay them out a large sum out of their pocket. So they will actually take the underlying asset, so that when that trader is correct, that they will have made the money on the underlying asset, and therefore they can pay them out without having to come out of their own pocket. However, the majority of clients are losing clients. These are people that are not consistently profitable, they're not funded, and over time they just lose money or blow up their accounts. And these clients can be traded against. So to show you the statistics of this, anyone that's got a brokerage account will know about this. But if you go onto one of the websites for these brokerage accounts, it says right at the top here, so this is IG, one of the biggest ones, 68% of retail investor accounts lose money when trading. Here's another example. They all have this. It's like a disclaimer on the front. I believe they're legally required to in the UK at least. But if you go to capital.com, you know, just another example, they've got this, and it says, nearly 80% of retail investor accounts lose money. So what does this imply? It implies, and I'm not saying these companies do, I'm not saying any companies do, I'm just saying it implies that they can double profit by trading against you. On the one hand, if you take a position and you lose, you have to pay them. On the other hand, if you take a position and they take the opposite side of that trade, so if you're long the S&P thinking it's going to go up, and they short the S&P of the same size, they've got an 80% chance, an 80% likelihood, if you're one of these 80% of retail investors that cannot trade properly, they've got an 80% chance that your long is going to be wrong, and therefore not only can they profit from your mistake, your incorrect call, but they can also trade the opposite way and then double profit, because they've got an 80% chance that by doing the opposite to you, they're going to be right. So if you're long, they can go short, and therefore they've got an 80% chance that that short is going to be correct and a profitable trade for them. Again, I'm not saying that these types of companies or brokerages are malicious in their intent in any way, shape or form, but this is just another example of how conflict of interest exists within this industry. Another example of conflict of interest are these traders, particularly I noticed these on Instagram and places like that, these Forex traders that are selling courses, selling trade signals. It's important to ask yourself why. Why are they doing that? If they are actually good at trading, if they can actually take money and make it into more money, if they can compound wins consistently and be profitable, then why have they got to sell you a course? Why do they want to sell you signals? And to my mind at least, I'm not saying there aren't some legit ones out there, but to my mind at least, if it sounds too good to be true, then it probably is. And these traders will love to make it look like it's very easy to become very rich overnight without doing much work, in order to get you to buy their courses or they copy their trades so that you don't have to worry about how to trade. You can just buy when they tell you to buy. But again, in most of the times, in my experience, these sorts of traders that are selling these courses and signals, they make far more money selling courses and signals than they do from actually trading the markets. So I'm not saying there isn't some absolutely great information out there. There certainly is. Most of what I've known and learnt over the years, I've gotten for free off of the internet. I personally am not an advocate for paying for courses or paying for books even. Again, there are definitely some great books out there, and this might not be the most popular opinion, but the point I'm trying to make here is great traders think for themselves, and they're not influenced by anyone around them nor anything they see. They simply weigh the evidence in front of them and think for themselves and make their own decisions. With all that said, I'd like to loop back around as I attempt to demonstrate how I've been thinking differently about this slap that I showed you at the start. So Oscar sponsors 2022 says it right there on screen, right? So where am I going with this? Well, again, you can kind of see that the official sponsors are here. And here's another example. So just some more outside the box thinking. This slap was in response to a joke. a joke made regarding this, okay, which has now got an awful lot of coverage in the news and the mainstream media, amongst other places. I mean, I'm even talking about it now. I never watched the Oscars in my life, right? But I just found it interesting that doing a little bit of digging on this, the sponsors are literally in the middle of finalising a trial for a remedy to this very thing that was joked about, that was the cause of the joke prior to the slap, which is blown up all over the TV and has made it into everyone's feeds. And so to summarise here, I am not saying this is why the slap occurred. I'm not here to comment on whether or not it was real or staged. I am not making any absolute statements whatsoever. I just thought this was a funny and contemporaneous example of outside the box thinking. It would be very easy to have watched this slap and then have a knee-jerk reaction. Oh, it was outrageous. Oh, it was this. Oh, it was justified. It was not justified. Whatever people's knee-jerk reactions might be, right? But as a trader, you must learn to think outside the box. And I thought this was a funny way to demonstrate thinking outside the box. So as a trader, be trusting of nothing you see. You must take everything into consideration, all angles, and most importantly, never buying into any hype of any kind. If you found this entertaining or you found value here at all today, please go ahead and hit that subscribe button. You can follow us on Twitter, subscribe to our YouTube channel, and we'll be posting more content every single day. So I hope you enjoyed it. I'm your boy Camel. Take care.